Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. I'm Rapstein, and here we are on Monday, the 25th of July, 2011. We're around the 4 o'clock area. I wanted to get through Congress coming out with their dog and pony shows today. The Democrats and Republicans, a bunch of nonsense as far as I'm concerned. This is politics at its worst, not its best. This is all about the presidential election. Now, you may not agree with that, but the game is for the Democrats to avoid a vote right in front of the election on budgets and debt ceilings, and for the Republicans to get that point there, and they want to get that vote. They want to rehash this all as the next election is going to roll around. I know I've put it in the most simple of terms. You may not agree, but that's what makes it go. I was on Fox Business today, and I said, all these guys, they all stink, and that's where I'm coming from. I mean, they're playing a dangerous game here, a bad game. The stock market doesn't think the game's going to get that bad. The stock market thinks things are fine. The gold market doesn't. The gold market is saying, whether you solve the problem or not, you've probably put into place already downgrading of U.S. debt. We already see that Europe's got its own series of problems with Greece. We don't know if there's anything else coming. You don't even hear about Iran and Israel at this point in time, but I'm hearing little talks of things going on behind the scenes. It's very interesting as you do your reading. So let's take a look at the gold. And what can you say? The gold market's come from a low that it made. If you look back, this was the high in May, right at the end of April, very beginning of May. We actually made a range that we didn't come out of in the first 5 days. Then you go into June, it was sideways, and you broke out mid-month of July. You went through a week of consolidation. This is a daily bar chart of the December gold, and today you lifted out of that. Let's blow the chart up so you can see this a little better. To me, the key is not to get under this low. In fact, specifically, what I don't want to see the market do is take out the 1585.90 level. Why? Because it's the last break low in the market according to the swing line. Let me show you this chart without a swing line on it. This is the chart with the swing line study. And to me, the swing line study is so important because it shows you very clearly higher highs, higher lows, lower highs, or a high and a lower low, wherever it's at. And it's a way that you can use, I think, if you believe in the pattern of what makes a trend is following up with higher highs and higher lows in an uptrend, or in a downtrend, lower highs, lower lows, you get to see where they come in. And right now, 1585.90 is the key to me. That is the number I do not want to see taken out. I then put on a chart a filter, the 18-day average of closes. And the simplistic theory is when the market is over it, you're looking for your signals to be buy signals. If it loses and you got under 1585.90, would I turn bearish? The answer is no, because prices are over the 18-day average. I'd wait for what I call a reset, the market to figure out what to do. And that can happen often. If you come back here and you use that theory, and I just want to show you this. This is just part of that overall theory, and then we'll go to another chart. Here's the market clearly with lower highs, lower lows. Market comes up this day, which is on Tuesday, July 5th. It seems so far ago, right? It was not. The market's at 15.15. As far as I'm concerned, you're out of the short positions. You're not bullish yet because you're not over the 18-day average. The market starts what I call the reset. Let's go to the next graph here. So you get that done, and I also add the 45 and 100-day averages, and they're underneath. For people that use moving averages, this is called a proper setup where the shortest term average is over the medium term, the 45-day, so 18 over the 45, and the 45-day is over the 100, all of the closing prices. The market's not near them, so those are layers of support under the market. I next look at potential resistance points. Bollinger Band is that study that I use. It's one of them. I use several others, in fact. But this is, to me, probably the most important one. And the theory is when the market gets up to that black line or down to it, It's a spot that the market is mathematically saying is a resistance point. Why? The algorithm that makes up these bands is designed to keep the market trading within the bands 95% of the time. So therefore, by design, 2.5% of the time you can stay over it or under it. One of the things that you'll hear me talk about is how often can it stay over or under it? How many consecutive days? They're not many. You can go back and study your own charts. You will see. Now, you want to trade the most active futures contracts if you're going to employ the theory the way that I talk about it. Now the market went sideways, taking off. 1642 is the next potential resistance. So without knowing anything else on the chart, I don't want to see 1585.90 taken out if I'm bullish, as long as it keeps in the bull trend. One of the objectives is in the 1642.70 level, and the momentum of the market is what I called locked in. See the red and the brown lines? They're made up of what's called a slow stochastic study, SSTO. The theory on it is pretty simple. Markets go between overbought and oversold conditions. They'll bounce around. But a market can change character. In this case, it got overbought. Notice the red line got up to the 80 level. And then it falls down into the 20 level and then turns itself around quickly. And suddenly, both numbers are locking in. They're just going sideways over 80. It's called embedded or locked in. And it changes the character of the market from my charting perspective. Does it always work? Nothing charting always works. This is more of an art than it is anything else. You get to the science part when you use the algorithms and so on, and you're looking at percentages. I don't believe in looking at chart patterns. A lot of people do. Unfortunately, I look at it and I get swayed. Today it's a head and shoulder. Tomorrow it's a wedge, a triangle. It depends on what I'm reading in the newspaper and where my head is going with it. But by using these, and I filter them, well, I have to stay, I'll use the word honest because I don't know a better word. It's not honest with you. It's honest in terms of the market is bullish until you take out 1585.90, which is the last break low. The stochastics are embedded, and you can't change those things. That's what I term it. Before I go on to the next chart, this week I'm offering my cause and effect sheet. You want to get this, in my opinion. It deals with the impact of which way markets may move depending on what interest rates do. It depends also in different times what's going on. In good times, you're looking if it's the government adding or taking money out of the economy. We know what it's doing right now. It's been adding money to the economy. How do low interest rates supposedly impact, for example, producer price index or retail sales and so on? Well, what are you going to do now? And the reason I think it's important with this debt ceiling issue. Where's the impact of that? I think we're playing with a game where we haven't improved the jobs in America. At least I don't think so. You're still near 10% unemployment. You certainly haven't done much with the inventory of homes. We are seeing a movement that is good, I guess, where apartment buildings are getting built, and that's where the growth seems to be, is the baby boomers are moving out of their homes. But what do you do with all that inventory? And if interest rates go up, how do you get employers to do anything? I'll give you another killer. Do you honestly think in this economy, with all that is going on, if you're an employer, you're sitting there with growth pattern right now? These congressmen don't understand what they're doing to private business. They're making them put everything on hold right now. Expansion, very difficult because you don't know the environment you're going to be in. The game of uncertainty is bad. There's always a certain amount of it. But now, when's the last time you heard us go into a default? I guess you'd have to go back to Clinton when the threats were like that, and the market didn't like what was going on then either. But the markets learned from it, and the marketplace is playing bluff poker to a certain degree with what's going on. Stock market collapsed last night. Maybe the word collapse is extreme, but broke very hard. Came back very, very strong today. People just don't believe yet that this can all play itself out in a bad way. In silver, I don't want to see 38.86 taken out. You can see that you have the embedded stochastic. I see resistance at 41.84. The copper market's the little game that is different. You've lost number one, your embedded stochastic. When that occurs, one of the things I teach is that the market often tries to make a run for the 18-day average of closes. Let me show you this. And I teach all this in my trading course. If you go to our website, www.iraepstein.com, go under the word education. It talks about our trading course. Here's an embedded stochastic. Been going sideways. Your pattern is higher highs, higher lows. This day, last Thursday, July 21st, the market loses its embedded stochastic. I then look for the market to make a run for the 18-day average of closes. Now, it can happen one of two ways. Market prices can break, or if the slope of the market's been going up, we may get the average coming up to the price. One way or the other, I'm looking for them to come together. The market bounces last Tuesday, and here's today's action. You came right down and held it. If you take out 436.50 now, I think the price action can get very ugly. The other thing that's happening in copper is notice how the Bollinger Band is rounding in. The market's probably going to develop a pattern more similar to this right now, where the market's going to contract in price. Support could be in the 426 area. If I'm wrong and you clear 442.60, well, then I might be arguing for the 450 area. This is a time of indecisiveness for some of these markets. The gold market's been, I think, a pretty straightforward play, and for those of you that get my twice daily updates, if you're calling for the cause and effect, we'll be happy to put you on, and you can see our opinion on the gold market there and how we've at least told our customers to play it. With that, I'm Ira Epstein. Have a great trading day, and I'll talk to you tomorrow.